Well, today's Friday, September 9th, 2016. It's been a pretty eventful day. We've been talking about risk and the stocks and bonds. I think that a lot of people don't realize that the bonds have so much risk, but they really do. They have a lot of risk, particularly sovereign risk. And not only do you have credit risk in the oil patch, which I think is reflected in a high yield. I think a lot of people are in the high yield looking for this high yield. I don't think they really realize that the risks that they're running, but they're also, as we learned today, that there's interest rate risk because, I mean, if you're at negative yields, and I think 44% of the sovereign debt at the moment is at negative yields, why you're just looking to sell your bond to a greater fool if you have any kind of interest rate upside at all, which we saw today. I think we broke the 50-day moving average, might even broken the 100-day moving average for bonds. Why? You get people who want to get out of the bonds, and of course, interest rates went up quite a bit today. And when interest rates go up, bonds just get massacred. So we've been talking about this. It's been a pretty eventful week. Hanjin out of Korea has gone bankrupt. They're one of the top cargo container shipping lines in the world. There's billions of dollars worth of freight sitting out into the ocean that's not going to get delivered. And of course, you know, timing is everything for these folks. So one has to wonder what's going to happen with that. So that still is going to have some ramifications coming along. So it's been a pretty eventful week. I'm doing some seminars in the next couple of weeks. And I had, what was interesting is that I had a meeting with a investor. And they were lamenting how in the 2007-2008 timeframe that they didn't realize that the market was coming to an end. And so I think that in my presentation, I'm going to put a big red flag and maybe ring a bell for my attendees to realize that, that the bell has rung, that the top of the market has arrived. I think we're going to be looking at a slight real estate correction, but here again, it's just a correction within an ongoing bull market. It can be pretty eventful. In 1980 was also a correction within an ongoing bull market, and that was pretty tough at that time. But here again, I think we're going to bounce right back. The nice thing about real estate is that we have such a nice cash flow component to it that is such a mitigating factor. If you just extend out your holding period, why oftentimes you don't even realize that we've gone through some bad patches. But here's what I'm advising, and keep in mind that people asked me just the other day, so well, if we do some investing work, and I think there's some excellent properties still available and some excellent opportunities. We're here in Phoenix. This is not Los Angeles. This is not San Francisco. This is not Silicon Valley or Vancouver or Paris or New York or for the Gold Coast or Sydney. This is still a working class neighborhoods for most part, and Phoenix is really number one or number two growth markets in the United States. So it's a pretty doggone good marketplace. So we have to separate ourselves. Remember, real estate is not correlated to Wall Street. It's really a regional, and sometimes it's a very local, and sometimes, real estate can be different from, meters from block to block. Some have views, some don't have views, and it's going to correct, make a huge difference in value. So real estate really is depending on location. And of course, if you're in a market like we are here, where you have a growth, people are moving here. We don't necessarily follow everything in the country. But I do believe that there are several markets in the United States. We had to talk about Gregory Mannarino saying that real estate was in a bubble, and of course, often parts of the country it certainly is. So I think those people may get hurt pretty bad. So here's what I am advising clients is that if you're going to need some cash flow, Phoenix is certainly going to provide that for you. But I would not be taking money from your savings account or your reserves. This would be money that'd be coming from like stocks and bonds. It would be a reallocation play. Keep in mind that you don't necessarily you can have real estate in your IRAs and have individually held. Directly held real estate in your IRA. You just have to have a self-directed IRA, and there's several around. and it makes for a very, very compelling investment. Particularly if it's in a growth market. And there's several around the country, and I'm just going to toot my horn here in Phoenix. I just think we're probably one of the best there is. But here again, in real estate is not just willy-nilly. I'm not saying that land is real estate as well. Office buildings, malls are real estate, and I'm not recommending that at all. We're extremely conservative. We're wound down to the bare bones here. We want to make sure that we have conservative, consistent cash flow. We're looking at really single-family homes that make very, very good sense. Homes are sold in ranges. We're buying at the bottom of the range or below the range to make sure we have some cushion in there. And we're buying in very, very good areas that will rent. And here in Phoenix, while we have a little bit of a shortage on rentals, particularly in the meat and potatoes, but that's not necessarily the first plateau, but certainly no later than the second plateau. So here in Phoenix, we're looking at anywhere from $1,100 to $1,300. Rents a nice house, and we make cash flow at that, and we find that most of our tenants can easily afford that here in town, and we have lots of properties that fit into that ball game. So what I'm saying is that you want to take your money out of stocks and bonds and get it into some kind of conservative, consistent cash flowing vehicle. And we're as conservative as we possibly can be. We're not buying big boxes. We're not talking about buying office buildings or medical buildings or malls or warehouses or God help us, vacant land. We're talking about things that are just very, 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 very conservative. And we'd like to see you maintain your cushion and your reserves, because if this gets, it could be a fairly strong correction. We have such huge excesses in both the bond and stock market. It could spill over into the real estate market. I'm expecting a little bit of a correction. I'm not expecting a Mad Max event, but it could be kind of tough. In which case, it's going to take some really forbearance, and it's going to take some fortitude, and it's going to take a little bit of courage, because as the markets get bad, that's really when we want to buy. It's just the greatest time to buy. When things are tough, that's when you want to buy. It makes it the problem is, I have this question all the time: should we wait until there's blood in the streets to buy? Sure. Of course we want to buy when there's blood in the streets. We get a very, very good buy. And we're talking about generational buys. I think that once we get through this and we clear this, clear all the deadwood out of the forest, I think that we have some really incredible upside potential coming, particularly here in town, particularly here in Phoenix, Scottsdale, Chandler. These are just going to be unbelievable. Peoria, just going to be unbelievable buys. Don't know why. Could be inflation. If we unwind the bonds and you really need to save the bonds, they just, I'm just astounded at what the central banks have done to begin with. They've got all the centralized coordination. And, I would never have guessed that they'd be doing negative interest rates. But, it's possible that you could wake up one day and say your dollar is now worth, 20 cents. And it's done across the world. In which case, if you, have $1,000, maybe you now have $5,000, but everything has, gone up 5 times. In which case, real things like sticks and bricks and housing and things would go up as well. That would be far fetched, but Lord God, I would never have thought any of this stuff would have happened to begin with, and it has. Who would think it'd be negative interest rates and you'd have people bidding to lose money? This just doesn't make sense to me. So listen, it's a very volatile market. Dow Jones down almost 400 points today. Some of our advisors that I deal with think that we're going to go down significantly more. So I've been talking about getting your assets out of the stock market, and at least take some of your profits off the table and move them and reallocate into a much more conservative class. At least at this point, real estate certainly has gone up, and certainly it can go down. But this would be asset preservation. I think that if you hold it for a 5-year, which would be the minimum time frame that we would hold as investors, 10 is generally more likely. And personally, I have properties I've owned for over 30 years, and they still cash flow. I still get money out of them each and every month. I have it's just a nice passive. I have no intention of selling those, so you may find that be the case as well. In which case, real estate will give you probably a little bit of safety of principal. But here again, there's no guarantees on that, but it would be a nice asset allocation. So listen, I'm going to wish you well for the weekend. If I can help you in any way, just give me a call here. We answer our phones. So have a really good weekend, and God bless you. Bye-bye.